October 15, 2008. Sarah Martinez stared at the letter in her trembling hands. After 12 years of mortgage payments, Bank of America was foreclosing on her family home. 3 blocks away, inside the gleaming towers of Wall Street, Jamie Dimon was celebrating J.P. Morgan Chase's most profitable quarter in company history. The same day Sarah lost everything, Dimon received a $20 million bonus. This isn't just Sarah's story. This is the story of how the most powerful financial system in the world became a machine designed to transfer wealth from ordinary Americans into the pockets of billionaires. And the most shocking part? It was all perfectly legal. But how did we get here? How did a system meant to fuel the American dream become its biggest threat? The answer lies in a century-old conspiracy hiding in plain sight. Manhattan, 1907. A financial panic gripped the nation. Banks collapsed, people lost their life savings, and the economy teetered on the edge of complete destruction. But one man saw opportunity in the chaos. John Pierpont Morgan gathered the most powerful bankers in America inside his private library. Behind closed doors, they didn't discuss how to help the American people. They discussed how to ensure they would never lose control again. "Gentlemen," Morgan reportedly said, "we must never again allow the government to have power over our money." What happened in that room would shape the next century of American finance. These men didn't just want to get rich, they wanted to become untouchable. By 1913 they had succeeded. The Federal Reserve was born, supposedly to prevent future panics. But the dirty secret was that the same bankers who caused the 1907 crisis now controlled the nation's money supply. They had essentially made themselves the government's business partners. The blueprint was simple: create complex financial systems that only they understood, ensure regulators were either former employees or future employees, and when things went wrong, convince the government that they were too big to fail. But the real masterstroke? They convinced everyone that what was good for Wall Street was good for America. Chicago, 1929. Frank Sullivan worked double shifts at the steel mill, saving every penny to buy stock in his company. His wife Emma kept their savings in a tin box under their bed, until Frank convinced her to invest it all in the sure thing stock market. On October 24th, Black Thursday, Frank watched his life's work vanish in minutes. The Sullivan family lost their home, their savings, and Frank never found steady work again. He died in 1934, broken and penniless. But here's what Frank never knew: the same bankers who sold him those safe stocks were secretly betting against the entire market. They knew the crash was coming because they helped cause it. Joseph Kennedy, father of future President John F. Kennedy, made millions by shorting the market while publicly encouraging Americans to buy stocks. When asked how he knew to sell, Kennedy allegedly replied, "When the shoeshine boy gives you stock tips, it's time to get out." The 1929 crash wasn't an accident. It was the result of wild speculation, margin buying, and market manipulation by the very people who were supposed to protect investors. And when it all collapsed, guess who got bailed out? The banks received government support to stay afloat. Frank Sullivan got nothing but bills. This pattern, privatized the profits, socialized the losses, would become Wall Street's signature move for the next century. Washington, D.C., 1999. In the halls of Congress, a bill was being debated that would change everything. The Glass-Steagall Act, put in place after the 1929 crash to separate commercial and investment banking, was about to be repealed. The man leading the charge wasn't a politician. It was Sandy Weill, CEO of Citicorp. Weill had spent millions lobbying Congress, hiring former government officials and wine-and-dining senators. His message was simple: regulation was killing American competitiveness. But Weill had a secret weapon: Treasury Secretary Robert Rubin, former co-chairman of Goldman Sachs. Rubin pushed hard for deregulation, arguing it would benefit all Americans. The day President Clinton signed the repeal, Weill was ecstatic. Within months, he merged Citicorp with Travelers Insurance, creating the largest financial institution in American history. What Weill didn't publicly announce was that Rubin would be joining Citigroup as a senior advisor, with a salary package worth over $15 million a year. This wasn't coincidence. This was the revolving door in action. Former Goldman Sachs executives didn't just influence one administration. They infiltrated them all. Henry Paulson went from Goldman CEO to Treasury Secretary under Bush. Gary Gensler went from Goldman partner to Obama's financial reform chief. Steven Mnuchin went from Goldman partner to Treasury Secretary under Trump. The pattern was unmistakable. Wall Street didn't just lobby the government. They became the government. Phoenix, Arizona, 2005. Maria Gonzalez cleaned office buildings at night and took care of her elderly mother during the day. She had never owned a home, but a mortgage broker named Rick assured her she qualified for a $400,000 loan. "Don't worry about the payments," Rick said with a smile. "Home values only go up. You can refinance in 2 years." What Maria didn't know was that Rick was paid more money for selling her a riskier loan. The more dangerous the mortgage, the bigger his commission. And the bank didn't care if Maria could actually afford the payments because they were going to sell her loan to Wall Street within weeks. On Wall Street, Maria's mortgage was bundled with thousands of others into something called a collateralized debt obligation, a CDO. These CDOs were then sold to pension funds, insurance companies, and foreign banks as safe investments. But here's the truly criminal part. The same Wall Street banks creating these CDOs were secretly betting against them. Goldman Sachs created $6 billion worth of CDOs in 2006 while simultaneously purchasing $22 billion in credit default swaps, betting those same CDOs would fail. They were selling poison while buying the antidote. John Paulson, a hedge fund manager, made this strategy famous. He worked with Goldman to create CDOs filled with the worst mortgages, then bet against them. When the housing market collapsed, Paulson made $4 billion in a single year. Maria lost her home in 2008. She was 63 years old and had to move back in with her sister. She never understood how the system worked. She just knew she had been destroyed by it. September 15, 2008. Lehman Brothers, one of Wall Street's oldest and most prestigious firms, filed for bankruptcy. The news sent shockwaves around the world. Stock markets crashed, credit froze, and millions of Americans watched their retirement savings evaporate. But this wasn't the beginning of the crisis. It was the moment Wall Street's decades-long con game finally caught up with them. In the aftermath, the truth began to emerge. Internal emails showed that bank executives knew their mortgage products were toxic. A Goldman Sachs executive called his own CDO products shitty deals. A JP Morgan executive referred to their mortgage securities as sausages, implying they were made from scraps no one wanted to see. Dick Fuld, CEO of Lehman Brothers, had been warning his board for months that the firm was in trouble. But instead of cutting back on risky bets, he doubled down. In the 6 months before Lehman's collapse, Fuld took home $22 million in compensation. Meanwhile, ordinary Americans were losing everything. In Detroit, entire neighborhoods became ghost towns. In Las Vegas, foreclosed homes stretched as far as the eye could see. Nationwide, 8.8 million Americans lost their jobs. But Wall Street wasn't done. Even as they begged Congress for taxpayer bailouts, bank executives were planning how to protect their own wealth. Washington, D.C., October 2008. Treasury Secretary Hank Paulson, yes, another Goldman Sachs alumni, stood before Congress with a stark message. Give Wall Street $700 billion or watch the American economy collapse. We need this money to prevent a complete meltdown, Paulson testified. These banks are too important to fail. What Paulson didn't mention was that his former employer, Goldman Sachs, was one of the biggest beneficiaries of the bailout, or that he had held private meetings with Goldman executives while crafting the rescue plan, or that he had personally called Goldman to warn them about Lehman's upcoming collapse. Congress approved the bailout, but with conditions. No executive bonuses until taxpayer money was repaid. Bank executives nodded solemnly and promised to be responsible. Within months, they were back to paying themselves record bonuses. AIG, which received $182 billion in taxpayer money, paid $165 million in executive bonuses just months after the bailout. When public outrage erupted, AIG executives claimed the bonuses were necessary to retain talent. JP Morgan Chase, which received $25 billion in bailout money, paid CEO Jamie Dimon $20 million in 2009. Bank of America paid CEO Ken Lewis $9.9 million despite the bank's stock falling 58% that year. The message was clear. Wall Street's losses were America's problem, but Wall Street's profits were Wall Street's business. New York City, 2010. FBI agents raided offices across Wall Street, seizing computers and documents as part of the largest financial fraud investigation in American history. Surely, after the devastating 2008 crisis, someone would finally go to prison. 2 years later, the results were in. Not a single major Wall Street executive was charged with a crime related to the financial crisis. Not one. The Department of Justice, led by Attorney General Eric Holder, who would later return to his law firm representing Wall Street banks, explained that prosecuting bank executives could destabilize the financial system. If you prosecute a major bank, Holder said, you risk destroying the American economy. This became known as the too big to jail doctrine. The same institutions that were too big to fail were now too big to prosecute. Instead of prison, the banks paid fines. JP Morgan paid $13 billion. Bank of America paid $16.65 billion. Goldman Sachs paid $5.1 billion. The total fines exceeded $100 billion, but not a single executive spent a day in jail. Compare this to ordinary Americans. A man in Louisiana was sentenced to 15 years for stealing $100 from a bank. A woman in Texas got 5 years for welfare fraud totaling $4,000. But bankers who stole billions got bonus payments. The two-tier justice system wasn't a bug in the American legal system. It was a feature. Miami, 2017. Cryptocurrency fever was sweeping the nation. Bitcoin had reached $20,000 and everyone wanted in. But behind the scenes, the same Wall Street players were running the same old schemes. Goldman Sachs publicly dismissed Bitcoin as a bubble while privately building a cryptocurrency trading desk. JP Morgan CEO Jamie Dimon called Bitcoin a fraud, then quietly purchased Bitcoin through the bank's investment arm. The pattern was identical to the housing bubble. Create excitement in a new market, sell products to retail investors, then bet against those same products while they collapsed. Meanwhile, a new threat was emerging in plain sight. Private equity firms, led by billionaires like Steven Schwarzman and Henry Kravis, were buying up American companies and stripping them for parts. They would purchase healthy businesses, load them with debt, pay themselves massive dividends, then let the companies collapse into bankruptcy. Toys R Us, Payless Shoes, Sports Authority, all destroyed by private equity firms that walked away with billions while 33,000 employees lost their jobs. The government's response? Tax breaks for private equity firms. March 2020. As COVID-19 spread across America, small businesses closed and millions lost their jobs. But Wall Street saw opportunity in the chaos. The Federal Reserve, now led by former investment banker Jerome Powell, announced it would purchase corporate bonds to support the economy. This was unprecedented. The government was essentially guaranteeing that big corporations couldn't fail. Wall Street banks borrowed money from the Federal Reserve at near zero interest rates, then used that money to buy back their own stock, inflating share prices and CEO compensation packages. Bank of America borrowed $24 billion from the Fed, then paid out $7.1 billion in dividends to shareholders. Meanwhile, the Paycheck Protection Program, designed to help small businesses, was gamed by large corporations. Ruth's Chris Steakhouse received $20 million. The Los Angeles Lakers received $4.6 million. Shake Shack received $10 million. But the most audacious move came from the hedge funds. Using sophisticated algorithms and insider information, they manipulated markets while ordinary investors were locked out of trading platforms. When retail investors on Reddit tried to squeeze hedge fund short positions in GameStop, trading apps like Robinhood, which received payments from Wall Street firms, blocked ordinary investors from buying while allowing institutions to trade freely. The message was unmistakable: the game is rigged and you're not invited to play. Today, as you read this story, the same system that destroyed Sarah Martinez, Frank Sullivan, and Maria Gonzalez is stronger than ever. The 6 largest banks now control assets worth $12 trillion, 60% of America's entire economy. These banks are bigger today than they were before the 2008 crisis. They have more political influence, more legal protections, and more ways to extract wealth from ordinary Americans. The revolving door between Wall Street and Washington continues to spin. BlackRock CEO Larry Fink advises the Federal Reserve on monetary policy. Goldman Sachs alumni fill key positions in both political parties. The regulatory agencies meant to police Wall Street are staffed by the very people they're supposed to regulate. And the media? Most financial journalism is funded by Wall Street advertising. The same banks being investigated sponsor the news programs reporting on them. Negative stories are buried, whistleblowers are silenced, and the truth is hidden behind layers of complexity. This isn't capitalism, it's a rigged system designed to transfer wealth from the many to the few. The pattern repeats itself every decade like clockwork. First, financial innovation. Wall Street creates new, complex products that regulators don't understand. Second, deregulation. Banks lobby to remove restrictions, claiming innovation requires freedom. Third, the bubble. Easy money flows into the new market, creating artificial demand and rising prices. Fourth, the crash. The bubble bursts, taking down ordinary investors while insiders cash out early. Fifth, the bailout. Government rescues too big to fail institutions with taxpayer money. Sixth, the bonuses. Executives reward themselves for surviving the crisis they created. Finally, the reset. New regulations are promised but never implemented. The cycle begins again. We saw this pattern in the 1980s savings and loan crisis. We saw it in the 2000 dot-com bubble. We saw it in the 2008 housing crisis. We're seeing it today in cryptocurrency, private equity, and too big to fail banks that are even bigger than before. Each time, the same people get richer while ordinary Americans pay the price. The dark side of Wall Street isn't about individual greed, it's about institutional corruption. It's a system where laws are written by the people they're meant to regulate. Prosecutors are afraid to prosecute. Politicians depend on Wall Street funding. Media coverage is bought and paid for. Complexity is used to hide theft. Bailouts privatize profits and socialize losses. Sarah Martinez never got her house back. She works 2 jobs now and rents a small apartment across town. Sometimes she drives past her old neighborhood and wonders how the people who destroyed her life never faced consequences. Frank Sullivan's grandson works on Wall Street today. He makes more in bonuses than his grandfather made in his entire lifetime. He's never heard the story of the 1929 crash. It's not taught in business school. Maria Gonzalez died in 2019, still paying rent on a small apartment. Her mortgage broker Rick now runs a cryptocurrency fund. He drives a Tesla and lives in a mansion in Beverly Hills. The system that destroyed these lives is stronger today than it's ever been. The banks are bigger, the schemes are more complex, and the politicians are more captured. But here's what Wall Street fears most: people understanding how the system really works. Because once you see the pattern, you can never unsee it. Once you understand the game, you realize it was never about free markets or capitalism or economic growth. It was always about power. And the people in power will do anything to keep it. The question isn't whether this cycle will continue, it's whether ordinary Americans will ever have the power to break it. That choice for now remains in your hands. If you want more deep dives into the hidden truths behind money, corruption, and power, subscribe, like, and share this video. The more people know, the harder it becomes for them to hide.